What's going on, everybody? It's Joe Gentle with Trend Trading Academy. I'm here to help you trade and get paid. Welcome to Make Moves Monday, motivation, mindset, and trading psychology. And in today's video, we're going to talk about 5 types of trading bias. This is going to help you with your mindset. Really, this is a lot of trading psychology. This is really how we respond to what we are doing in the markets. And this is going to help you to understand how to allow the markets to do what the markets want to do instead of you trying to force your way on a market that you really can't defeat. All right. So if this video brings you value, make sure you like, comment, and subscribe. If you're ready to become a student, go to trendtrading.academy. You can become a student and jump on board with everybody else and dominate these markets. All right. For now, let's get to it.
Have faith in your mind, faith in your grind, invest in yourself, transform in your time. Have faith in your mind, faith in your grind, invest in yourself, transform in your time. When you trade and get paid, 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 trade and get paid.
All right, guys, so let's jump into it. I want to talk about trading bias today. In Make Moves Monday, you know we like to talk about motivation, mindset, and trading psychology. So today, we're going to focus on that trading psychology. This is going to really help you because most people don't have their, their bias out of the market when it comes to each trade that they're going to get into. You know, we talk about emotion, we talk about skill set, we talk about, keeping your emotions out of things. We talk about all that kind of stuff, the mindset, the positivity. We talk about a lot of different things when it comes to trading, but we really need to also talk about our psychology about each individual trade. In other words, what are we thinking? Not just emotionally attached to, not just what does our strategy say, but what is our mindset, our psychology, what is our thought process about each individual trade? Okay. And one of the things that affects you is a thing called bias. So the word bias simply means to have, prejudice or favor to one thing over another, right? So essentially, if you're biased, then that means you are kind of not given a fair opinion of one thing or another. You may say your children are the prettiest girls in the world.
Aww.
And while you may, think that, and rightfully so, you should think that. That is probably a biased opinion, right? So, my kid is the smartest kid in class. That's great. I'm glad that you feel great about your kid. But that's not necessarily a fact simply because of the way you feel, right? And it doesn't, again, not taking away anything from, your relationship to your children in any way, but I'm simply saying that many times we have a biased opinion. We may look at a sports team. This is going to be our year. We're going to do it. We made the right moves. And, all the experts may say, no, they didn't make the right moves. But you, being a homer, this is our year. This is our year. That's called bias. Okay. You want to see something happen. You would like to, see it happen. And you are almost talking yourself into making it happen. So many times we're let down at the end of the season when that team is not doing so well. So bias can be pretty tough, especially when it comes to our trading, because if we go into a trade thinking buy or thinking sell, or maybe thinking this is going to be a long-term move and it happens to be a short-term move, or we think it's a buy, but it ends up being a sell. We think it's a sell, it ends up being a buy. It can really start to mess us up some. And so having our bias, not just our emotions, not just our skill set, not just our risk management, not just our money management, but our bias, our individual trade psychology under wraps, that's going to be very powerful for you to have sustainable success in the market. So let's talk about what trading bias looks like. The first thing we need to understand is that there are 5 types of trading bias. The first one we're going to talk about is called representative bias. So this is just what it sounds like. It's representative. It's kind of like what you represent, right? So what this type of bias does is it will cause you to do things that have caused you to be successful in the past. You know, it's like, I did this, and this, and I won a couple trades, so I'll just keep trying that same thing. And while in some cases that may actually be good because it helps you to develop a pattern, if you become biased, then that will cause you to mess up when trades want you to do something different. What I mean by that is there's good and bad. To have a pattern or to have a confirmation checklist is a powerful thing, and you've heard me talk about that. However, when you allow that to become a bias, it can become a negative. Your confirmation checklist and going by your, maybe a couple of set of rules that you have for your strategy, that's awesome, and you should do that. However, if you allow that to get overbearing or too much in your strategy, then it can become a bias, meaning that there are no good trades out there unless these things happen. All right. And here's the thing. I believe if you have a confirmation checklist or if you have a set of rules, you should stick to those rules. However, you have to also understand that your rules are not the only rules out there that work. And the reason that's important is because there may be times and seasons in the market that we have to adapt. Not that we have to change our rules, not that we have to go and, relearn how to trade or nothing like that, but the fact that we may understand that depending on what your strategy is, there may be seasons or pairs or news events or fundamentals or sentiment that doesn't allow for that particular set of rules to work quite as well. So maybe there are some other things out there that will help you to become better or to win in current circumstances. As a representative bias, what we can end up doing is we stick to, kind of carrying out analysis based on these preconceived ideas of what we think the market should be rather than what the market actually is. And when we think that the market should buy simply because we see 4 rules that are being, adhered to, then the market sells, then we're confused because we say, well, man, everything was checked off my checklist and I still lost. And now that brings discouragement. And now that brings all the other stuff we're talking about, the emotions and all this kind of stuff. So it's very important that we do have the set of the confirmation checklist, the set of rules and all that, but that we don't get so attached to one way of doing things that we don't allow the market to teach us what it wants to do. We can't force the market to do what we want it to do. We simply have to allow the market to do what it wants to do, and then we follow. We ride the wave. We've talked about it before. We're surfers. The wave comes and we ride the wave. We don't force the waves to happen, or we don't cause the waves. We're simply those who ride the momentum of the wave. So even if something has paid off for you time and time again, never close the door to adapting. Never close the door to being willing to learn or to expand your horizons, okay? Just because something is paid off does not mean it's the only thing that can pay off. Another thing to keep in mind is that many times trades may seem similar, but different things may need to be applied and adapted as the market conditions change. How you may trade something in maybe January to March may be different than how you trade that in November and December. And that doesn't mean that those rules won't apply in November and December. It simply means that you may have to apply it differently or may have to adjust it a little bit to make sure it fits in what the current situation is. Something may apply in the summer months when trading is hot, but then it may change as news events happen. It may change as inflation rates go up or down, or interest rates go up or down. So there are fundamentals that affect what we need to do in the market. And if we have representative bias, then we say, this is the way I've always done it, and I'm always going to do it this way. That's not the way we find longevity and success. We always have to be willing to adapt, but we have to be firm upon our set of rules. The second type I want to talk about is negativity bias. And really it's what it sounds like. Some people just approach everything from a negative level of psychology, meaning that as soon as something goes wrong, we find it. And it could be 9 things went positive. You could have made 60 pips in a trade, but your target, maybe you were hoping to get 70, and you took profit, you got 60 pips, you know, maybe you made some good money, but because you didn't get 70, you're like, oh, I didn't get the target, so everything is bad, everything is bad. Well, no, it just means that you needed to adjust how far you went in that trade. Maybe there was some level of resistance or support that you didn't see properly. Maybe there was some market manipulation. Maybe some news caused it to go a different way. There's a lot of outside factors that we have to take a look at, and we can't just be negative because something didn't happen exactly how we wanted it to happen. You know, we think the bias is, you know, there is 70 pips coming out of this trade. Well, we get 60 of them and we don't get the other 10. We take our profit, we made money, and now we say the bias said there was supposed to be 70. Well, I didn't get 70. This was a failure. No, this wasn't a failure. This was an adjustment. Okay? So negative bias, here's what a negative bias will do. You'll have a whole entire strategy or a whole entire risk management plan or a whole, even a trade plan that if you take a couple losses, you're ready to scrap the whole thing. You're ready to get rid of all of it and throw it in the trash because maybe it didn't work exactly like you wanted it to, when really it wasn't that the strategy, the trade plan, or whatever was bad and needs to be thrown away. It might just be needing a slight adjustment to fine tune it. All right. So what I want to encourage you is, as you grow as a trader, don't just scrap something the first time it don't work. How can we adjust? How can we apply a little differently? How can we manipulate or move and be malleable in the hands of the market? How do we allow the market to mold us a little bit so that we're able to flow with the ebbs and flows of the market and not try to fight against it? All right. Don't throw out every good thing that you've ever learned, every good thing that's ever happened simply because you took a couple losses. It's just time to go back to the drawing board. Take a step back. Maybe you don't trade for a day or two. Maybe you take a step back and you kind of just evaluate, where am I as a trader? Was it the trading that the strategy that was wrong? Was it the risk management that was wrong? Was it the money management that was wrong? Was it my trade plan? Was there some kind of level of discipline in there that I didn't act right? Was my mindset off? There's so many things that could happen. Was there some market manipulation? Was there some outside fundamental factors? Did market sentiment change? Did something happen in the news? Did GDP do something? You know, there's so many things that can happen, and rather than just scrapping or throwing away an entire good structure that you may have because it doesn't do exactly what you hoped it would, maybe you just adjust it a little bit. Maybe you don't have to throw it all away. Maybe you just can get a positive bias and say, you know what? I didn't take 70, but I did take 60. What can I do to adjust so I can take 70 next time? What can I do to adjust to make sure that I understood exactly how far the trade was going to go next time? Okay? Don't approach everything from a negative. You don't always got to fix everything. You don't always got to throw away everything. You don't always got to restructure and rebuild. Sometimes that causes you more problems than it's worth. What you need to do is first evaluate the things that you have and take the good from every situation. The next one we're going to talk about is status quo bias. Status quo bias is really just when you are just wanting to kind of not rock the boat, right? and while again, this is kind of like the first one where it can be very powerful and it can be very good. You know, we don't need to reinvent the wheel. We don't need a new strategy every week. We don't need to have new things and new methods every week. I see many people fall prey to wanting to try to every strategy out there. You know, I used to be an RV salesman. I used to sell RVs for a living, and I remember when I would get a customer or a client that would want to come in and look at RVs, I'd only want to show them, maybe 3 or 4 RVs at max, because what happens is, somebody goes and looks at this one, and then they go look at this one, and then they go look at this one, and they've looked at 20 others at 12 other dealerships. and then they come back to me and they say, well, I want the kitchen from this one I saw, but I really love the bedroom in this one, and I love the way the living room looked in this one, and I love the exterior of this one, and I love and what they want just doesn't exist. There isn't an RV that has that kitchen and that bedroom and that, unless you maybe build it custom, but it was so hard to make a sale to those type of people because they had given themselves too much information. They had gone, if they would have just looked at a few that they really liked and made the decision that this is the one that best suits me. It may not have every little detail. Yes, I may have to get a different microwave. Yes, I may have to change the table out or something like that. but it gives me everything that I want for, the best value that, people would have been able to, buy a lot more RVs or whatever. But in this case, when it comes to trading, that's what we do. Is we're looking at moving average crossover strategies. Then we're looking at oscillator strategies with MFIs and RSIs, and then we're looking at some type of a RSI or a parabolic SAR dot flip, and then we're looking at the Ichimoku cloud, and then we're looking at this, and then we're looking at that. Oh, we're looking at this new strategy. If I put these two indicators together, they do. And by the time it's all said and done, you can't even remember where you started. Now you're trying to piece together 25 pieces of information that may not coexist, right? So it gets to be too much. So rather than, that's all bad. But the other side of that is to just be status quo and you just sit there. I'm just going to do a moving average crossover strategy and I'm never going to do anything different. This works and that's it. Well, that's fine and good, but what about when the market's consolidating? Now you have fake outs. That sounds great, but what about when market conditions don't allow for that, right? So what I'm telling you is the status quo, while it is safe, it is also very, it's too reserved. You can't just say, this is what I've done for 100 years and I'm never going to be able to adapt, or I'm never going to change, because market conditions change. And the way you may have traded last year may not, not that it won't work, but it may not apply the same way this year. And again, kind of like what I talked about in the first bias, is as different things come, different market conditions change, maybe elections, maybe, COVID, all this kind of stuff happens. Suddenly your strategy doesn't quite apply quite as well. So you need to be able to adapt. Notice a theme going here, that with all the bias, the answer is being willing to adapt. Have you noticed that yet? With each level of bias, we're finding that the answer, the key to success, is being willing to adjust, willing to adapt, and to be moldable by market conditions. Don't force your way through when market conditions just aren't allowing it. The status quo mindset tells you not to change anything. It's that bias that if this is the way I've always done it and this is the way I'm always going to do it. But the danger of that is that market conditions change. And while your stuff might work in a trending strategy, it might not work for pullbacks. It might get you faked out a lot. It might not work when there's consolidation. It might not work when, there's overbought conditions. It might not work when there's oversold conditions. It might not work during news. And so, yeah, sure, it might work for the different things you do, but there might be a lot of times that you're not trading too. So don't be stuck in status quo. Be willing to adapt, but just don't go too far where you're trying to explore 4,000 different, strategies. Find what works for you and stick with it, but always be willing to adjust. Always be willing to adapt, but only adapt and only adjust when you need to. That's the balance. Don't just be adapting and adjusting because that's what, Joe told me on Make Moves Monday. But no, adjust and adapt when the market tells you to. Adjust and adapt when market conditions change. Not because you watched a YouTube video, not because somebody showed you a new strategy. Always be willing to learn, but never be willing to change until it is time to change. I hope that makes sense. Number 4 is confirmation bias. And what that means is that you're literally looking for confirmations to what you think already in your head, right? You think this is going to be a buy, so you're finding 20 confirmations, and sometimes what you see is really what you're looking for. You may actually have confirmations that say, no, this is not a buy, but there's sell confirmation. So that's not what you're looking for, so you don't see it. Does that make sense? See, we have to come to the market with no bias at all. We have to just come and say, what does the market want to do today? Not what do I want the market to do, but I'm not looking for confirmations of what I want the market to do. What I'm looking for is, what is the market telling me over and over again? So when you hear us talk about confirmations, we're not telling you to get a prefabricated idea and then find a bunch of stuff that'll support it. That don't work. What we're telling you is, erase your mind of any bias. Look at what the market is doing simply. Even if you got to remove marks or, from your charts or whatever you got to do, but get to a clean chart, look at it and say, what is the market telling me? What are these candles saying? And then start looking for the different things that the market is saying. And then you start to look for high probability. Don't just say buy. Now look for all the things that look like a buy and neglect the things that look like a sell. No, come into a non-biased chart and say, what is the market telling me? And then just look. Okay, this thing looks like it says buy. This thing looks like it says buy. This thing looks, okay, there's just a little sell bias here. So let's look. And then when we put all of the information together, we make an educated decision that, is there enough confirmation that tells us to go one way, even if we do have maybe some negative information here? Do we have enough information? Is this a high probability that these pieces of information are going to be the way the market moves? And we enter the market based on high probability trade setups, not on bias, not on 100% guarantees, but we take all of the information, not just the ones that we want to hear. You ever talk to somebody that they hear only what they want to hear? Well, I feel like we treat the market that way sometimes. We only hear what we want to hear. But sometimes the market is trying to tell us the raw truth. One thing I'll tell you about the Forex market is the Forex market don't lie to you. The Forex market tells you the raw truth, and it's up to you to take it or leave it. All right? So get all of your confirmation bias out of the way. Meaning, again, that does not mean that I'm telling you not to look for confirmations. What it means is, don't come in looking for preconceived confirmations. Come in and say, what does the market want to do? And then start looking for what the market is telling you without a preconceived opinion. Okay? Because biased traders get faked out every single day. Last but not least, we're going to talk about gambler's bias. And what I mean by that is people that base stuff off of feeling. You ever watch a football game or a baseball game? And particularly in baseball, people are very superstitious. And maybe a really good player is in a slump. Maybe an Aaron Judge or somebody who's really, really good player. Maybe they're 0 for 20 in their last 20 at bats or something. And here's what people say: oh, he's due for one. Yeah, I wouldn't bet the bank on it. So what I'm telling you is, this is how we approach the market sometimes. It's up, 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 up. The market's been trending up. It's due to come down soon. And we start looking with bias for sell opportunities. Ooh, that's dangerous. Guys, don't go into a market starting to look for what's due. No, take all that bias out of the way. It's not about what you think is due. It's simply about what the market is telling us. Get all your bias out of the way. Don't come in and say, the market's due to start selling soon. Be honest with yourself. You've said it. The market's due to start buying soon. The buyers are due to get into the market. That sounds good. But don't put your money into that. Always look at the market without bias, right? Come to it and say, I don't care, right, what the market has been doing or what I think the market is due to do. But I want to know, what is the market telling me it wants to do? I'm going to come in and I'm going to look at price levels. I'm going to look at supply and demand zones. I'm going to look at market structure. I'm going to look at the candlesticks and see what they're telling me. And I'm going to make decisions based on that, not based on what I think it needs to do. Not, it's been buying, so I'm going to keep buying, it's been dropping, so man, I'm going to start, sell. No. Just simply take that gambler mentality out of it. Just look at the information. That's it. The only thing that matters is the information. Get the bias out of the way and simply trade the information. Always be willing to adjust. Always be willing to adapt. Always have a set of rules. None of these things are like conflicting. How do you say to me, have a set of rules, but be willing to adapt? Sure, easily, because I'm going to trade these set of rules no matter what. But I'm also going to learn how these rules may apply differently under different market conditions. I'm not going to change my rules. I'm going to simply apply them differently under certain market conditions. I can't apply a moving crossover strategy in a trending market the same way I would apply a moving strategy crossover in a consolidating market, right? I can't apply a Bollinger Band squeeze the same way in a big trend that's coming to an end, or the same way I would as it's been in a consolidation for a long time. I've got to trade those differently. I've got to apply those differently, right? The Bollinger Band expansion, or whether it's an RSI, overbought, oversold. Maybe you're looking for a divergence. Maybe, I don't know what it is you're looking for in your personal strategy, but the way it is applied in one condition is not necessarily the same way it's applied in a different condition. So when we come into it with bias of any kind, we set ourselves up for failure. We set ourselves up to get messed up, to get faked out. So all I'm telling you is stick to your strategy, stick to your rules, stick to everything, but be willing to adapt. Don't come at the market thinking buy or sell. Simply come at the market thinking movement. Don't come at the market thinking 100 pips. Come at the market thinking trailing stop. Ooh, you see what I did there? That's what I'm talking about. Just let the market do what it wants to do, and then we just ride the wave. That is how we keep our emotions in check. That's how we keep our strategy relevant. That's how we keep everything under wraps, and we adapt everything to each individual trade rather than this year, this month, this, that. No, every trade, I'm going to go through my checklist. Every trade, I'm going to do analysis. Every trade, I'm going to look buy and sell. Every trade, I'm going to look for the right confirmations. Every trade, I'm not going to say because it did it once or twice, it's always going to do it. I'm not going to say because it didn't do it once or twice, it's never going to do it. I'm simply taking all bias out of the way and saying whatever the market wants to do, I'm going to let it do it. And I'm going to be there to ride that wave. That's how we take bias out of the market. That's how we keep our emotions in check. And that is how we build long-term, sustainable success in our trading psychology. All right, guys, there you have it. I hope this video really helped you out. We talked about the types of traders' bias. So let's talk about that. I want you to comment below and let me know how this affected you. Did you identify yourself in one of those types of bias? Do you find yourself doing these types of things? And is that hindered you? Is it hindering you currently? And now do you see a path out to find success where you might have been hindering yourself before? Don't forget to like, comment, subscribe. And if you're ready to see a great trading strategy, I want you to watch this video right here. It's going to really help you out. Don't forget to become a student, trendtrading.academy, and let's get this money together, guys. I'll see you in the next class.